Hi, traders! The Williams Fractal indicator is an effective tool for identifying key price levels. Let's take a look at how to use it to build profitable day trading strategies. Williams Fractal is a simple yet very useful indicator that helps identify important support and resistance levels on the chart. The appearance of an upper fractal indicates potential resistance. The appearance of a lower fractal indicates potential support. Let's break down how a fractal is formed. An upper fractal occurs when the high of the current candle is higher than the highs of two candles to the left and two to the right. A lower fractal appears when the low of the candle is lower than the lows of two candles to the left and to the right. It's important to note that fractals are confirmed with a delay of two candles. The indicator is displayed only after those candles have closed. The problem with the standard indicator is that it shows too many fractals, which can be confusing. In an active market, for example on the hourly chart, you may see dozens of fractals, many of which do not provide accurate signals. The solution is to use a custom indicator, such as Williams trailing stop loss. It allows you to change the fractal range. I recommend disabling unnecessary lines in the settings and increasing the range from 5 to 9 candles. This filters out noise, leaving only key levels, which makes analysis cleaner and trading easier. What you should not do when using Williams fractals. Beginners often perceive fractals as reversal signals. When they see a lower fractal appear, they enter a buy, and when an upper fractal appears, they sell. In practice, this approach shows low effectiveness and leads to a large number of losing trades. It is much better to use fractals as breakout signals, additionally filtering them by trend using the 200 EMA. Add the 200 EMA to determine the trend. If the price is above the 200 EMA, focus on upper fractals for buys. If below, focus on lower fractals for sells. Wait until the candle closes above the last upper fractal to enter a buy, or below the lower fractal to enter a sell. Set the stop loss below the entry candle for buys, or above it for sells. The take profit should be 1.5 times the stop loss. Let's look at a specific example. If the price is above the 200 EMA and a breakout of the upper fractal occurs, this gives us a buy signal. We place the stop loss below the entry candle, and the take profit is 1.5 times larger than the stop loss. For the second scenario, when the price is below the 200 EMA, a breakout of the lower fractal signals a sell. The stop loss is placed above the entry candle, and the take profit is 1.5 times larger than the stop loss. Now you know how to use Williams Fractal as a breakout strategy, but for more precise entries, combine fractals with the Alligator and Stochastic RSI indicators. First, determine the trend using the Alligator. The three lines should be pointing in the same direction and be separated. If they are all pointing upward, it's an uptrend, which means we are looking for buys. If they are pointing downward, it's a downtrend, and we look for sells. Avoid sideways markets where the lines intersect. Under what conditions is it best to enter a trade? In an uptrend, wait for a lower fractal when the stochastic RSI shows oversold conditions below the 20 level. In a downtrend, wait for an upper fractal when overbought conditions are above 80. Set the stop loss below the fractal for buys and above it for sells. Close the trade when the price reaches the middle line of the Alligator. Now you have two effective fractal-based strategies. The first is a level breakout strategy with a 200 EMA filter. The second is a pullback strategy within the trend, confirmed by the Alligator and Stochastic RSI. Both strategies are easy to implement and adapt to your trading system. The key is not to rush, to filter signals, and to follow proper risk management rules. This is a simple and powerful strategy that works. If the video was helpful, hit like and subscribe. See you in the next video.